There's a good chance that the last decade of investing will go down in history as one of the best. Unfortunately, Vanguard's latest report says those days are numbered. They say that we need to plan for lower returns, sticky inflation, and rising interest rates. Let's talk about what this report is predicting in detail and how we can respond. Before we get going, it's important to note that no one knows the future. No expert, no panel, no person on YouTube can predict exactly what's going to happen. The people over at Vanguard are very smart. They have a very high level of integrity, and overall, I trust them. But again, they don't have a crystal ball. And so what we're going to do here is go through their logic and go through kind of why they think the way they think. They even make specific recommendations on how we can invest in the exact funds we can invest in to try and get the best returns over the next decade. And we'll go over that too. So this doesn't count as financial advice. It's not infallible, but I think it's interesting to talk about. This report that I'm looking at is something that Vanguard develops for their own use in-house. So when their people are talking to their own clients, they'll use this material to talk to them and explain kind of why they're doing what they're doing and what the outlook looks like for the next 10 years. And so I'm not that person. I'm not a Vanguard trader or something like that, but I'm a nerd and I wanted to read all 59 pages of this PDF. And so that's what I did. Let's talk about bonds next. A lot of people have bonds as part of their investing portfolio, their investing plan. That's all a portfolio is. And what Vanguard is predicting here is for bond rates to continue to rise a little bit over time. The exact prediction is actually raising them up to between 1.4 and 2.4%. So that's quite a bit higher than it's been here recently. The placeholder for a bond has always kind of been to diversify your overall risk. If you're 100% into stocks, that's the most volatile up and down roller coaster you can have. If you throw some bonds into the mix, then it can level out some of those highs and lows. And so for some people, if you want a more stable return, this could be very good news. All right, now let's get into the good stuff, which is global equities. All we're talking about here is what's happening with companies all over the world, and specifically what would happen with like the stock market. We'll get right to the prediction here. What Vanguard thinks is going to happen is we go down from really awesome, crazy high returns for the last 10 years down to what they call fair value stock projections. Fair value. I'll read this straight from the PDF. It says, specifically, we're projecting the lowest 10-year annualized returns for global equities since the early 2000s. Bombshell. And this is part of where we're going to flip the script on what has come to be the expectation over the last 10, 12, 13 years, basically since the financial crisis of 2008-ish. We've all expected the US to outperform everybody. We've had the most growth. We've had the most kind of optimism. We've had tons of people start investing here recently, and so more money gets pumped into the market, which drives prices even higher. Now Vanguard is saying all that's changing. They have the least amount of optimism when it comes to US stocks. That's really strange to even hear or read, but that's what they're predicting. What they anticipate is that the places that are actually going to get the highest returns are developed markets outside of the US. So we're talking about big commercialized first world countries that aren't the US. They're saying are going to get better returns than the US. And this is for the whole next decade. This isn't talking about 2022 and 2023. This isn't talking about for the next 6 months or something like that. This is for the next 10 years. Surprisingly, they also predict that emerging markets are going to get better returns than the US. This was a shock to me because recently emerging markets have not done very well. Overall, what this means is it's just going to be a big shift for us if they're right. Who knows if they're right or not? But based on their study and them putting all their heads together, what this is going to mean is basically flipping the script for all of us who are used to US investing and US being the core of our portfolios. One of these models they do is called a CAPE ratio model. And so this is a little chart that they put up in their PDF that basically shows this is like analyzing the fair market value of the stock market. And so the higher that blue line goes, the more it's overvalued. And so you can kind of point those things out there where the dot-com bubble happened, where it went way over the kind of fair market value of the stock market. Like where the blue line deviates from that gray little squiggle is basically where they're spelling trouble. And so if we continue to follow that path, you've got 2020 where we all know what happened. The sickness, the Rona happened and it went way down. And then now it's come back up and shot up again all the way past that gray kind of fair market value forecast line. Here's a different example in case that's confusing. Let's say that you are going to go buy a new vehicle. Now, when things are going really well for an automaker and their dealers, they might be able to sell that vehicle not just for the sticker price that's actually on the car, like the suggested retail price. They might actually be able to tack on another $5 or $10 or $20,000 on top of that price, where they say, look, these things are so popular. They're in such high demand that we don't need to sell them for the sticker price. We can sell them for way more than that just because we can. happen. Just because there's a line of people after you. If you don't want it, somebody else will. And so that's a similar thing that's happening with the stock market right now. So they're by no means claiming that we're in another .com bubble or that we're going to see another drop like we did there in 2020. They're just saying that this level of growth, that high spike there at the end, is going to level off quite a bit. If you'd like to follow along, please turn to page 39 of the giant 50-some plus page PDF here. Here's a really meaty part of their prediction that I want to sink my teeth into. This chart shows their predictions starting 10 years ago, and then it carries them forward for 10 years from now in the future. And this is a simulated portfolio, a simulated mix of investments that's 60% stocks, 40% bonds. The first part on the left part of this chart is saying that the actual return ended up being quite a bit higher than they predicted. And the reason for that is here on figure 11-3, which is essentially saying, you guys are a little too optimistic. That behavior chunk there being up 6.4% is saying people are illogically valuing investments way more than they should to the degree of 6.4%. I mean, what's happening here is people are buying so much that it's driving the price up. And so Vanguard had only predicted a 7.4% yield when really it's been 16.8. It's been huge. Inflation has been higher and earnings were better than they thought, frankly. So that explains why, as of 2021, the actual has outperformed Vanguard's little prediction there. But as you can see, the next 10 years here, for 2021 through 2031, that chart's going down. And that doesn't mean that's what's going to happen to your account value. This isn't a prediction of what your account will look like. These are the percentages of returns they're thinking that you should expect. So right now, what they're saying is, hey, it's 2021. We're expecting somewhere in the range of a 6-7% return, something like that. So that means that they would think that if you had a similar portfolio of 60% stocks, 40% bonds, that's the kind of return you should expect for the year. Now, if we fast forward 8, 9, 10 years from now, that's going down quite a bit. And to qualify, this is returns for a globally diversified portfolio. This isn't just American stuff. So even if you're globally diversified in the future, the returns are still going to be not great. I mean, by the time we get down here into 2031-ville, we're talking about 4%, 5%, something like that. So hopefully inflation has gone down at that point because as of right now, that's barely keeping up with inflation. So if we want to get into specific predictions here, because that's what people like, here's a chart for you. And I'm going to summarize this because there's a lot of numbers and little goofy candlestick, pogo stick looking things up there on the chart. What this is saying is these are the ranges that we predict these different kinds of companies to return over the next 10 years. So this first one here is called US small cap. That's not a tiny hat that some guy's going to wear. What that's saying is these are small companies. Objectively, they're still big. They're publicly traded companies. We can buy their stock. So it's not like it's some tiny company like mom and pop's chocolate chip cookie shop on the side of the road. These are still big companies, but comparatively, they're small. So they're saying their median prediction, based on their range of possibilities, there's this big swath of it could happen, but their median prediction, 3.2%. Could be crazy, could be 11.8, could be terrible, could be -5, but the median's there in 3.2. And then these are different kinds of investments as we go across. Value, REITs, global, not US equities, so stocks that are not in America, US growth stocks, US equity, and finally, US large cap. So in the last 10 years, I will summarize this for you here. In the last 10 years, US large cap has done really, really well. Growth has done quite well. I mean, all the stuff in the US that basically favors the big high-tech companies has just exploded in value. Vanguard is putting the kibosh on all that. They're saying, there's no way. Based on everyone being way too optimistic, the price has risen to a point that it can't sustain that kind of growth. It's going to level off and instead look at some of these other things. So if we say, okay, how do we set ourselves up? In theory, not as financial advice, but what do we invest in? Here's some of the actual funds they talk about. If you want to take advantage of their recommendations and of their predictions, this is what you would invest in. I'm going to focus on Vanguard ETFs because their Vanguard Active Strategy suggestion here, the fund, I think has higher fees than the ETF. Because to me, anything with active in it means that you're like paying a human being to do certain things. We don't need to keep anybody on the payroll. We want really low fees. We don't need that extra drag on our returns because if you're paying them a fee, that's coming directly out of your investment returns. So let's keep our returns as high as possible. Their global equity ETF they have listed here as a suggestion is VT, which is a total world index fund. That's saying we're not just looking at the United States, it's the whole world. So it's actually investing in both foreign and US stocks, but this could be a way to just throw a bunch of money into one fund and be done and go, okay, maybe Vanguard knows what they're talking about. So instead of trying to pick and choose which international company I should invest in and how do I do that, you could go to one fund and get exposure to the whole world. If you did want to isolate your investments to where you're going internationally and you're not investing in the United States, then VXUS, which is a total international stock fund that's not the United States, would be a great option. What they're estimating again is that their annualized return for this will be between 5.2 and 7.2% compared to 2.3 to 4.3 for US equities. So you could potentially double your return by going with something like VXUS over something like an American S&P 500 fund or something like that. If you remember, we talked about emerging markets before, and that's the kind of smaller, less developed countries, if you will, not smaller physically, but smaller when it comes to like economic development. So an emerging market fund that you could invest in if you wanted to is VWO. And so what Vanguard predicts is that will also perform better than the United States. So if you did something like the previous ones where you're doing a VXUS, you should be getting everything outside of the US. But if you wanted to dial in on those emerging markets, those up and comers, then VWO is where you could go. Now, if you wanted to stick to American stocks and American companies, but pick the ones that Vanguard thinks is going to do a better job than most of the other ones, you could look at value stocks. And so the Vanguard ETF for this is called VTV. It's a value fund, and they think that it's going to outperform growth stocks pretty handily. For this one, they're predicting it's going to get between 3.1 and 5.1% returns, and that growth stocks are going to get basically a negative return. I mean, somewhere between like -1 and 1% for the next decade. And so why would you get 0% interest when you can get 3 or 5% interest? Other options along the same vein here are VONV and VFVA. I feel like I'm talking code to somebody, like it's a secret message or something saying these letters, but that's not what it is. These are ticker symbols. So if you want to invest in these things, you can go in your investing app, you can type in that symbol, VTV, VONV, VT, VXUS, whatever it is, and it should come up then as an option for you to invest in. Finally, if you're interested in a bond fund, that would get you a little bit more of that sort of risk balancing factor that we talked about in the beginning of the video. Vanguard's fund BND is a total bond market fund. So it's kind of buying all the bonds all at once, make it easy for you. That's between 1.4 and 2.4% on the prediction scale of Vanguard. And so it's not going to make you a ton of money, but it could potentially level out some of the highs and lows. This is not a doomsday message, and this is not a perfect prediction by any means. I mean, no one can do that. No one on the internet, no team of experts can perfectly predict what's going to happen here, but it's probably logical to think that times will change. That's the only thing we can count on being constant is change. If you want to read any of these reports for yourself, I've linked them in the description for you. I like to have a secret comment section for people who have watched my video, and today the secret comment word or emoji is balloon. I've said the word inflation more than ever in like my life in any other video, and so we're gonna go ahead and do balloon because that's like inflation, you're inflating the balloon. If you enjoyed the video, then go ahead and leave me a comment or an emoji that says balloon in it, and I'll keep an eye out for it because these are my favorite comments by far. If you haven't already seen my review of Vanguard's updated investing app, then you should check that out right here because I think it's worth using. But you tell me, you go ahead and watch this video and see if you think that the app is actually worth using. And if you've already seen that video, then think about watching this one, which is the worst investing apps for beginners. Maybe you clicked on this video and you're wondering what kind of investment app you should use if you wanted to go ahead and get started now. Don't use these. They're terrible. Stay away.